Good afternoon, Options Trading Signals members. This is J.W. Jones coming at you with your weekend video analysis. Hope everyone had a safe and enjoyable weekend. I know I certainly did. I've been enjoying all the sports that have been going on. We obviously got the baseball playoffs, the American League champions, Texas Rangers clinched last night, and we've got the National League going on tonight, where the St. Louis Cardinals have an opportunity to clinch. We had a great day of college football yesterday. Got NFL today. I mean, this is the life, if you ask me, for sports. But let's go ahead and jump into the charts here, as far as where we're at and what's going on, and then a little commentary maybe at the end. This will be a little bit longer video, but I'll get the analysis done first before I do a little commentary on Europe. I just wanted to throw a few ideas out there to members and what may or may not happen. But let's go ahead and look at the S&P 500. We're looking at the E-mini futures contract. This is the daily chart. Right now it is, as far as time is concerned, it's 2:37 Eastern Time, Sunday, October 16th, 2011. Futures market is not open at this time, so we don't have any real price action going on here in the S&P, but I want to point out a few things here. This is the daily chart of the S&P futures, and what we can see is that obviously Friday's close was wild. Major volatility came in on the close Friday. I mean, we had some huge swings, and just to kind of illustrate that, let's just take a look at a 5-minute chart just for fun. Take a look at this short-term time frame, and look at this price action here on Friday. You know, we rally up to 1220 and then flush in, let's see, basically 20 minutes. We rallied up to 1220 and sold off to 1213. So 7 points in 20 minutes. And then we rallied back and actually went up even higher and closed basically right at 1220. This is not an example of a healthy market, everyone. I want members to recognize the fact that we've had a 14% move in less than 2 weeks. In a recent article that I wrote that went out Friday, there's only been, I think, as I recall the writing and the research, 4 years since 2000 where the return would have beaten 14%. We've made more money in the S&P 500. The S&P 500 has rallied more in the past 10 trading sessions than what the actual annualized returns were for 6 of the last 10 years. This doesn't exemplify a healthy market. These kind of rallies, this is not normal price action. I just want members to recognize that. So where do we go from here? I mean, at this point, we've got major overhead resistance starting to show up. This level right here at 1230 is a major level. Another area that's going to be key is this level that corresponds with the March pivot lows. That's around 1240. So we have layered resistance at this point. We are at coming into major resistance. Then we have the neckline of the head and shoulders pattern that triggered this initial sell-off, and it's going to be triggered up here maybe as high, we'll just call it a little bit below this 200 period moving average, the yellow line, around 1270. I mean, we've got major resistance. The fact that the S&P 500 could rally through all this is it possible? Yeah, anything's possible. But to keep going at this rate, the higher we go, the more concerned I'm going to get, because look at this. This is parabolic price action. I mean, it's just going basically straight up. We've had 2 days of the past roughly, let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9. Yeah, I can count. Good for me. But 7 out of 9 of the past trading sessions have been positive on the S&P, and we're not talking a little bit positive. We're talking huge upside move. So when we zoom this thing out, I mean, this move is just incredible. So where do we go from here? I think we probably wouldn't shock me tomorrow to see prices work higher. This 1230 area is going to get touched. We're going to test it. We may test it in the overnight session. We may rally past it. I don't know what's going to happen, but we're getting to the point where we're coming into some major overhead resistance levels, and the market strength here, while it is clearly obvious there's been serious strength the past 2 or 3 weeks, we're starting to see overbought conditions showing up on a variety of different time frames and a variety of different technical oscillators and analysis. So that's kind of where I'm coming from on the S&P 500 E-mini. I mean, can we keep going higher? Absolutely, but we're starting to get to the point where the rally is getting a little long in the tooth, as they say, and a pullback would at least be healthy. What I'd like to see is a pullback that we carve out a higher low. So maybe a pullback down to here, and then we push, higher still. That would be bullish price action. But if we just roll over and die here, we're just gonna. I mean, it's we need to see. I'd really like to see a lower high, maybe a 50% retracement of the move, maybe a little bit more, shake out a few of the bulls, and then we rally and come into this level late in the year. That would make sense. It would correspond with a lot of the cycle analysis that's out there. Most of the cycle work that I look at, the Elliott wave stuff, some of the other types of analysis, we're coming into a period of time where there's some key dates in October, and a big pullback would make sense to me at some point. It may be, a real quick, sharp pullback. It's really hard to say, but it would certainly be healthy to see us carve out a higher low and then we rally into year end. And that would fit a lot of the Fibonacci analysis. It also fit quite a bit of the Elliott wave stuff that's out there. Quick look at the SPX. This is the S&P 500 index. It's a little bit different than the futures. And what I want to point out is I've got all these key resistance levels drawn in here. It's pretty impressive. I mean, really, the only line that's kind of weird is this. I apparently drew this line in a little bit wrong, but obviously I'll do a little redraw here. As far as where we're at now, you could conceivably put that here, but we may have to move it up. It's kind of pointless, this descending trend line. Just try to ignore it. But the point is, we're kind of in this kind of range where we could come up into here 1230 and then push back down and go even lower yet. We've got major resistance at the 1250 to 1260 range. So I mean, similar story with the index as well as the futures. There's just a ton of overhead resistance. I wanted to illustrate that to members. Take a look at the VIX. Had a major breakdown. This is bullish price action here. There's no way around it. We broke the key support 31 level, and we closed near the lows for the session on Friday. This is very bearish price action here. There's not. I'm not going to illustrate any key levels. We'll be watching to see if in the next few weeks we can regain this 31 level. But as long as we're below this area, prices are the benefit of the doubt is going to be with the bulls. So the bulls have a victory on the VIX chart right now. But if we can see the VIX regain the 31 area, I think we could see some nice the bears step in and a nice sell-off transpire. Let's go through the usual suspects. IWM, clear breakout coming into major lateral resistance here with some of these recent tops. Here's a pivot area, 71.89. Another one around 74. At this point, I decided to opt to wait with IWM on Friday and see what happens on Monday. The reason I'm doing that, these charts are so extended. A sharp pullback would really help us out, and we might even be able to get out of the trade with at a break even by just waiting a couple days. No matter what, we're going to roll into the November. Butterflies for the SPY and for IWM and possibly even the SPY. So this trade isn't going to be over. I know we've got some losses there. I've got losses. We're going to roll forward and we'll get those back over time. Because that strategy, the butterfly strategy, I will tell members, its success rate's usually around the 60 to 70% range if we do it every month. So over a period of time, that strategy is going to work very well. It's just the volatility we've had in this huge run in the past 12 trading sessions has really made things difficult. So that's not generally the case, but we will be looking to roll. I'm going to give it a little bit of a more leash, but we aren't going to let the thing ride into Friday unless some big sell-off takes place tomorrow or Tuesday. Let's take a look at IYT. Transports have got a clear break. Again, similar to IWM, we've got these lateral resistance areas that are going to start coming into play. There's going to be some resistance in here, and then we've got even more resistance up here at the 88 level. That corresponds with the March pivot lows if I zoom out. Here's your March pivot lows from earlier this year. There's major resistance there. So we get a lot of layered resistance on IYT, similar to IWM. XLF, financials acted kind of funky on Friday. They didn't really get up and go. Don't get me wrong. They did rally and they pushed higher, but they're not breaking out. They're nowhere near a breakout. We've kind of got it almost looks like a double top. I know it's not, but it kind of looks that way. The financials really need to get going here. Most of the other usual suspects have already taken out this area, and on the financials, they'd be looking at trying to get up into this range, this 1350 area. We haven't even on financials seen this area get taken out, so this is at least a warning sign for the bulls, unless financials really start to play catch up in the next few days, which I doubt. As far as emerging markets, huge rally here. We're back into this range. We really had a nice rally in EEM. Right at the 50-period moving average. You're going to have some lateral resistance that's coming in, and you can see there's some lateral resistance around the 39.50 range. There's lateral resistance around 41. So there's a lot of resistance coming into play. You could even say, throw this line in here, you've got this area of resistance. There's just a ton of resistance on this chart, and we're seeing that across the board. So I think we're getting close to the end of this move higher. I don't know how far we push, in the S&P. We could push another 3 to 4% pretty easily, but after that, it's going to start becoming a very difficult road for the bulls. As far as the dollar index is concerned, dollar index is coming into some major support here. This is the original breakout area right here. I've got outlined. It's around the 76.60 area. This horizontal line is the original breakout. We're going to see price come back down, probably test it. Wouldn't be shocked to see that happen the overnight. Note the 50 period has crossed the 200 period, so we got a golden cross for those technicians out there. The last time we had a golden cross on the dollar index, let's just take a look back in time here. Let's take a look at the weekly chart. The last time that we had the 50 period moving average, I apologize, I've got that on the weekly. If we look at the daily chart, let me zoom this thing out a little bit. I'm kind of doing this on the fly, so bear with me. I don't know how far it's going to let me go here. Okay. So the last time we had a golden cross on the US dollar was back in February of 2010, right here. This is the last golden cross, and you can see what happened. Right now we have crossed, the 50 period is clearly crossed. That hasn't happened for over a year and a half, and last time that happened, it really led to a rally. We could see the 50 period get tested here, and then a bounce and a bump and go, and I think that may play out. The dollar is critical. This area has to hold, otherwise the bulls are really going to be in control. There's so much support underneath this price, though. The dollar is actually, the more I look at this, the dollar is actually relatively attractive for a possible long here. There's a lot of support underneath price. I still think the Euro FXE, that ETF long term, I think could be a really good short. But right now, a little bit preemptive. Don't be shocked if we don't get some directional trades. I'd like to see the dollar come down a little bit more and at least test the 50 period, maybe come down to that horizontal support, that original breakout area. I think there's going to be some major buyers stepping in there, and I think we could see that area represent the bounce that we've been looking for. Gold futures trading right at the top of the range. This would make sense based on what's going on in the dollar. But again, lots of overhead resistance. Still hasn't been able to take out that 1685 range. We've got major long-term resistance up around 1700. I'll extend this out a little bit just for the sake of ease. But we've got major resistance around 1710. This area could roll over, especially if we start to see the dollar bounce. We're not out of the woods yet with gold and silver. They've rallied for over 2 years. A 5-week correction isn't going to reduce a 3-year rally. Silver, similar situation. A little bit different though with silver. Silver is underperforming gold. We're starting to see it kind of roll over a little bit. I think as long as silver stays below this key top, this recent top around 33.65, As long as it stays below that level, I don't think we're going to see much in terms of a huge rally. We got major resistance overhead. Right now, silver doesn't look like the place to be. Oil is broken out of this descending trend line, but again, similar to oil, or excuse me, similar to gold and silver, we're coming into major resistance. We got resistance $90. The $90 level is huge resistance. We've got another pivot high right in here on 89. There's some resistance at around 88. There's a ton of resistance coming in here on oil. Oil's ran real hard, real fast. Got a little bit of a pullback, which is healthy. This thing may push all the way to 90, but from there I think we probably get some sellers stepping in again. I don't think there's anything on the economic horizon that's going to push oil to this huge high and break out, and we keep on going. I think we're probably range bound, and we may be getting close to the top of that range. As far as treasuries are concerned, the 10-year treasury futures just ugly here. We got a bear flag formed. This thing, unless price can get back up into this range, this thing is these bear flags typically resolve to the downside. We'll see if it plays out that way. If 10-year can get back into this range, it's going to be a problem for the bulls. Just one more signal that I'll be watching for. The 30-year, a little bit different with the 30-year. It has broken down, but again, here's our bear flag. Price looks a little bit different because we've got a little more support beneath the 30-year. The 10-year just rallied like crazy, not a lot of support levels, but the 30-year has a key support level that if we break down, this bear flag breaks down, this support level should hold, and we could see buyers step in and support prices there. And that's kind of a wrap up of where we're at across the board in the marketplace. Now, that pretty well concludes the technical side of things. I want to take a minute just to let members know kind of what I'm seeing in Europe. Right now, over in Europe, and I know this is going to be, some of this may be a little controversial. If you disagree with me, I understand. Everybody's entitled to their own opinion. I am of the opinion that the governments in Europe are going to fail in the process of trying to prop this situation up. Here's my reasoning. I'm going to basically draw a parallel from the European crisis we have going on now to the banking crisis we had in the United States in 2008 and early part of 2009. The biggest problem for most of the banks in the U.S. at the time was there was no capital to absorb all these losses. So the Federal Reserve created all this liquidity. The banks were able to basically borrow their way out, and then in order to pay off the Federal Reserve, as things started to improve, they were able to sell their stock at higher prices, sell off some assets. They got the Federal Reserve paid back, the Treasury paid back. Everybody's fine. Everything looks good. The problem with most U.S. banks is if the banks had to mark the assets they have on their books, if they had to mark to market, all the U.S. banks would be insolvent tomorrow. Most people don't realize that. Their capital levels are way too low if they had to mark to market, because if they did, the capital write-downs would draw their capital levels down to so low that they would have trouble functioning as a depository institution. That is something you can research and look into, but it is, in fact, unfortunately, the way things are as it stands. The mark-to-market accounting that has been basically negated by the Federal Accounting Board has changed the way financial institutions are showing their balance sheets. It's making things look much better than they really are. So what does that mean? How does that correlate to Europe? Well, here's the problem in Europe. You have instead of having a bank having a problem, you have sovereign debt issues. The Euro countries over there, they can't print money. The Euro Bank can print money, but there's restrictions and a variety of mechanisms in place that make that very difficult. So they can't print money like we can through our Federal Reserve at the United States. So what happens then in the case that these banks start to collapse? It's not the banks that are going to be the problem. What happened in 2008, and here's where we draw the parallel. 2008, Bear Stearns goes down. J.P. Morgan, Jamie Dimon picks up Bear Stearns. They spend about $1 billion to buy the bank. They make a ton of money. Great investment for J.P. Morgan. But here's the thing. All the shorts on Bear Stearns, they had been just killing it. Killing the stock, killing the bonds, the preferred, just crushing everything. and the short sellers were circling around. They just targeted Bear Stearns, just kept working it down and working it down and working it down. Finally, J.P. Morgan has to buy it. Well, what happens next? All the short sellers, the target that was on Bear Stearns, it moves. And now, I'm not going to go through a history lesson, but that target moves to a new entity. And let's just pretend that the next entity was Countrywide. Now you got the crosshairs on Countrywide, and the short sellers there are driving that price down until, Bank, or I guess it was Bank of America, had to buy Countrywide. And it gets confusing to me after that. There's just all these different things. But the point is, that bullseye goes from one bank to the next bank to the next bank until finally Lehman Brothers happens and the whole system almost explodes. What do you think is going to happen? I posed this question in Europe. Greece is critical. They came out over the weekend. The German finance minister said the write-downs are going to have to be much larger than what was originally anticipated by the private debt holders of Greece. They originally made an agreement back in July. It'd only be 20% write-downs. Half these countries are not. Their banks and their investors are saying we're not willing to take a larger haircut than 20%. Where's that money going to come from? These banks, the banks over in Europe right now, can't even go to the private market to access capital. They have huge capital problems. And to give an example, the Dexia bank, which went under not too long ago and had to be nationalized, just to give you an idea, I believe the numbers as far as Belgium was involved in that, Belgium's outlay in terms of capital for Dexia Bank alone was 15% of their gross domestic product. And that was just a portion to back it up. So Dexia is just one bank. You have all these other banks that are out there. So what do you think is going to happen? Greece, let's say Greece defaults, which I think is inevitable, and I think anybody paying attention knows it's going to happen. They've done it like 4 or 5 times in the past. They're going to do it again. The problem is all these other countries, banks are holding Greek debt. So there's a write-down. What do you think is going to happen? The bullseye is going to move. So who's the next weakest link? I don't know who it is. Is it Ireland? Is it Italy? Is it Spain? Portugal? I don't know. But the short sellers are going to move as soon as Greece defaults and they make as much money as they think they can. They close the shorts and they move on to the next guy. It's the same thing that happened here. And the problem that the European government can't seem to wrap their head around, they can't backstop. They don't have enough money to capitalize their banks. They do not have the capital to do that. That's why that vote that we were talking about last week with the EFSF, which is the European, it's basically the European equivalent of TARP to backstop all these banks. They're going to increase it. Well, I hate to bring it to the Europeans, but the Dexia Bank, their expectations and their capital expectations to backstop that bank and to nationalize it, the real costs and the estimates were very different in terms of percentages, to the tune of over, I believe the numbers are somewhere in the 50 to 60% range. They were off to the bad, meaning it took 50 to 60% more capital to backstop that bank than was initially anticipated. And oh, by the way, Dexia Bank passed the most recent European bank stress test. It failed. It's already failed. That bank is gone. So what happens to all these other banks? That's the real question, because now you're going to have, let's just pretend that Europe or that Greece defaults and there's an Italian bank that had 40% of its assets tied to Greece. I don't care, maybe it's 20. And that means that their capital position got written down significantly. So where's all this money going to come from? And that's the question. And and already our Federal Reserve is stepping up to try to help backstop them. And now U.S. taxpayers are going to be on the hook for this through the IMF. The International Monetary Fund is going to have to get involved, and the U.S. is going to be involved. And your taxpayer dollars are going to go to Europe to help backstop their banks. You can count on it. Just pay attention, watch how it plays out. The IMF's going to get involved, and all of a sudden they're going to save the day. The point I'm trying to make is the market is rallying on all this news. The problem is there going to be enough capital, and do you actually put faith in the European governments to backstop this problem when they were warned about the problem before the euro even became in existence? They were told not to do it, that this was going to happen. They ignored those wishes. How does this play out? I personally think it's going to play out very poorly, because I think the risk and the amount of capital that's going to be needed are being grossly misstated to the to the downside. I mean, there's going to require so much more capital. So what am I really saying here? Ultimately, what I'm trying to say is that I think Europe, while we are getting a nice rally in the S&P 500, I would remind readers that and members, right after TARP was announced, the Dow rallied like 1,000 points, and within 6 weeks of the TARP being announced and passed, the market was down another 15 or 20%. So all these things that are going on in Europe, are they really answering the problem? Probably not. Are they kicking the can down the road? Absolutely. But the problem with Greece is that they're already seeing signs that the recent austerity measures they were supposed to pass, they're already coming up short. The amount of money these countries are being forced to pay into Greece is exponentially higher than what they were expecting. Greece is having trouble getting their expenses low enough to continue to get these loans. And who in their right mind as a taxpayer, if you're a German taxpayer, are you going to vote? Are you gonna think it's okay for your representatives to allow your tax dollars to go to a country that we all know is going to default? That's where the real question is. How much longer are these countries taxpayers going to keep politicians in office that are going to continue to kick the can down the road? I know if I was a German taxpayer and I'm seeing all my money go to Greece, eventually I'm going to get fed up and say enough's enough. Let them fail, and I'm going to vote for the politicians who believe what I believe, and that's already happened in Germany. It's already underway. So to me, this is just a house of cards. I don't know how long it's going to last. I don't know what the end game is, but I don't think it's going to be pretty. I hope I'm wrong, and I'm sure there's a member out there that can argue with me. And if you put up some good arguments and you disagree, I'll be happy to post them. Uh, but I'm just looking at this. I've done a lot of research, a lot of reading. I just don't see how this ends well. I think at some point we will be looking to get short the euro in size, because I do think it's gonna take a huge hit, but I don't know when that's going to happen. I don't know if it's going to happen in the next 6 weeks or the next 6 months or the next year. But this process in Europe, they have a totally different structure than what we have over in the United States or in Canada. So with that being the case, it requires all these different governments to agree. There's a lot more working pieces. I just think it's destined to fail. The German taxpayers and the French taxpayers can only take on so much burden, and once one country falls, I think the shorts are going to start circling the others, and they've already banned short selling, which that removes a layer of liquidity and a layer of buyers. And I think the volatility could be exacerbated to a point that it could make 2008 in the United States seem minuscule compared to what could theoretically happen over there. I'm not trying to be a scare tech. I'm not a scare guy. I'm not a the world is falling. I'm just looking at this from a proactive, logical standpoint. And if somebody can explain to me how all this is going to work out, I would love to know, because you're putting a whole lot of faith in a bunch of people, particularly politicians, that have very little background in these instruments. They don't understand the complexity of financial markets. I think in the end, that the fact that they don't understand and that they think they can just keep kicking the can down the road and things are going to get better, that process may actually make things even worse than they would have been if they just would have swallowed their medicine from the get-go. So that's kind of where I'm standing. I know that's a pretty lengthy explanation of what I'm seeing going on, but keep an eye on Greece, because if they default, that's going to be the time we're going to know, because the shorts are going to start swirling. And once Greece goes down, who are they going to target next? And if they do target another country, what's going to happen there? And how is it going to exacerbate the amount of time it takes for that country to default and those banks to collapse? And that's the real problem. How many banks are going to collapse? How many, because if Greece defaults, okay, some of these banks will probably be okay. But if Italy defaults, not even Italy, if Portugal defaults, if Ireland, let's say Portugal and Ireland default as well. And the other thing is, if Greece defaults and they get away with it and there's no real harm done in terms of their country, what's going to keep some of these other countries from saying, you know what, we're not going to pay the austerity measures, we're just going to take the haircut and go. We're going to take our haircut, we'll go back to our original currency. You guys have a nice day. Sorry for the trouble. That's the other side. There's an unintended consequence to all this socialization over there, and the way it's going to pan out, I don't know. But to me, there's no way that this ends well. So with that said, I'm going to get off my soapbox every now and again. Longer term members know I throw some stuff at you to make you think a little bit. Love to hear your thoughts. Love to hear some opposing comments. I'm sure there's some people that disagree vehemently with what I've said. I'd love to hear those comments if they're written in an orderly and polite fashion. I will show them and discuss those in the open. I'm just putting this out for conversation. I'm not saying that I'm going to be right or that I'm 100% spot on, but those are my thoughts. That's my opinion, and I think in the end, Europe it's going to be ugly before this thing gets over, and I think it could get really bad if certain decisions are not handled appropriately. So with that said, I hope I haven't ruined anybody's weekends or depressed anyone, because that wasn't my intent. The world isn't ending. The sky's not falling, at least not that I know of. But we do have a lot of headwinds, and I think at some point the market will come back to the realization that things are not nearly as rosy over in Europe as what they appear. So with that said, hope everyone has a safe and enjoyable weekend. I will be in touch tomorrow morning with your standard video analysis minus the soapbox. Take care, and I'll talk to you soon.